All right, there are no called strikes in investing. Great, great expression, and we have Warren Buffett to thank for popularizing this phrase, one of the most useful investing expressions of all time. And in the description below this video, I'm going to have a link to Warren Buffett actually describing this expression himself. And I encourage you to listen to that to kind of get the meaning of it from his perspective. But I'm also going to share in this video kind of more nuance to this expression and how it actually describes a type of structural advantage that we have as individual investors that is a disadvantage for institutional investors. Got to remember that a lot of individual investors, they kind of think the game is rigged, that the institutional money has certain advantages. You know, they can pay high-priced analysts, they have an informational advantage. This actually is not true, and this expression will help illustrate why. So we'll get to that in just a minute. So now let's talk about the actual sport of baseball and how investing differs from baseball. And for those international viewers who don't understand baseball, basically you're a batter and the pitcher throws the ball, and if it's going to come down the middle, it's a strike, you kind of have to swing. And if you get 3 strikes, you're out, right? So there's a lot of pressure to swing at any pitch that looks like it might be a mediocre pitch or a good pitch. Now with investing, there are no called strikes, meaning you can stand there and wait until you see your pitch, right? So the market might pitch you General Motors at $40 a share, and you think, that's an okay pitch, but I'm going to let it go by. And then it pitches you General Electric at $6 a share, and you think, no way am I going to swing at that, and you let it go by. And then COVID happens, let's say, and the market pitches you Boeing at 99 in the middle of the COVID crisis, and you think, that looks like that could be a good pitch, but I'm not really sure about how bad this COVID thing is going to be. It might be more serious than I expect. I'll let that pitch go by. And there's zero pressure on you to swing at any of these things unless that pressure is self-imposed, right? Which is a nuance. So the whole idea is you can wait until your pitch comes at you. And you wait for that floating, drifting wiffle ball that you can really crush. And you allocate some capital to that specific pitch, take a swing, and you crush it out of the park. And you can wait until you really see your pitch. Okay. Now, on the institutional side, they have a completely different set of structural incentives, right? Because they have client money, they have clients. And so for them, metaphorically speaking, they have an audience that is pressuring them to take swings, to show activity. And if you think about it, let's say you have money in a hedge fund and they're charging you 2% plus 20% of the gains. You're going to be upset if they're not actually holding a different collection of stocks and actually doing things to invest your money, right? The mutual fund industry, likewise, typically they have funds with maybe hundreds of stocks, so they're showing sort of over-diversification, and they have holding periods that are kind of 3 to 4 months. That's the average holding period for most stocks on the institutional side. So there's a lot of activity, and this is because of client pressure. You're investing money with an institution, and you expect to see activity, and you expect to see sort of results as well. But a lot of the activity can actually hamper their performance. And so they have an audience yelling at them to swing, and if you don't swing, those clients can pull their money and take it away. Whereas you, as an individual investor, you don't have clients. You don't have to worry about this set of pressures. The only pressure you have is maybe self-imposed, sort of FOMO-based pressure, fear of missing out, that might get you to take action. Or maybe financial media might impose sort of an urgency to take action, but you don't have to respond to that. You can actually wait and wait for your pitch. And this is a major structural advantage where you can wait for some really, really attractive investment and then take a swing. You don't have to take any kind of action sort of just because. So keep that in mind. There are no called strikes in investing, and you do not have to swing at any given pitch and wait for that slowly drifting wiffle ball and crush it out of the park. And you think about that as sort of a central metaphor for how you can wait for the investments that you want to make. So as always, I hope these videos are helpful, and thank you as always for watching.